So you wanna trade stocks, don't you, boy? That's how they talk in those old gangster movies.
You know what it is, don't you, boy?
I think that was a good intro. Hey, welcome back to the channel. We're watching the Brown Report, where we talk about all things investing, stock market, and money mindset. And in this video, I want to break down the 5 mistakes that most stock traders make so that you can avoid them and get on the other side of profit. Let's get into it. So mistake number 1 that most stock traders make when they're buying their first stock is that they buy at resistance, known as buying too high. If you're not familiar with resistance, that is a level where the stock traders or the other investors, they don't like it at that price. They either feel it's overvalued or they feel like the stock price has run up too far too fast, unless there's some new information that comes in. And without that new information, people aren't willing to buy the stock and take it higher. So by you buying at that so-called ceiling of the stock, there's typically nowhere else for it to go but down, again, until some new information comes out or earnings or some catalyst that pushes the stock higher. The second mistake that most stock traders make is that they sell their stocks at support, which is the opposite of buying at resistance. See, what happens is they buy it too high where it has nowhere else to go but low. But then the mistake that most stock traders make is because the stock is selling off and they may be down like 2,000 bucks, they end up selling their stock and taking a loss, all for the stock to turn right around and go back up. Let me give you an example. Let's just say you bought a stock at $20 and support is at $15 and resistance is at 20. When you buy at resistance at 20, it's hard for the stock to go higher. So then it sells off. And the mistake that most people make is they say, oh my gosh, I'm down $4 and it goes down to 15. So if it goes down $5, I'm just gonna get out. I'm gonna cut my loss. Well, what happens is you cut your loss right at 15 when really you should have been buying at 15 instead of taking a loss. Or, like we teach our students inside of Power Trades University, perhaps you should have been adding to your position to bring your cost basis down at 15. And then when it turns back around and goes back up to 20, you can get out at a profit. But that's the second mistake that most traders make, is that they sell their stock right at support when they should be holding or adding to it and waiting for that turnaround to happen. Mistake number 3 that most stock traders make is that they're not reading stock charts. This one is a combination of mistake number 1 and mistake number 2. Mistake number 1, you're buying at resistance. Mistake number 2, you're selling it at support. Well, both of those mistakes could be alleviated if you don't make mistake number 3, which maybe mistake number 3 should really be mistake number 1, is that people don't read stock charts. And so because you're not looking at the stock chart, you're not understanding that there is a pattern, that there is a position of resistance and support that you should be paying attention to. Thus, you end up flying blind and like a bird who sees a window and on the other side of it, a tree, smack, your account gets killed. Right. Mistake number 4. I don't even know what mistake number 4 is. Mistake number 4. Mistake number 4 is buying the stock due to hype, okay? This company's the next Tesla. This is the next best marijuana stock. This is the next best whatever, right? And so there's all this hype around the stock. Your friend's friend, cousin told you it's the next Bitcoin. And so you gotta have it. And what you do, you inevitably run into a stock that was only being moved due to hype, and you buy it at the highest levels. And once all that hype is over, it's like, all the air is let out of the balloon and the party's over. Game over, the balloon is flat, and so is your bank account. It just got flattened out like it got hit by a car. Crushed like a pancake, and some Bisquick and some oil getting ready for breakfast, okay? You just lost your account. Don't make that mistake and buy into hype. Mistake number 5. Most people make the mistake of buying the stock of the company that they work for. The reason that this is a mistake is because your company may be a great company to work for, but that doesn't mean it's a great company to invest in. Case in point, I live here in Michigan. We're in the Motor City in Detroit. Nothing against the Motor City, but let's take Ford Motor Company for example. If you've bought Ford Motor Company stock over the last 17 to 20 years, you probably bought it around $17 or $15, and today the stock is trading somewhere around $9 or $8 per share, okay? And so basically, if you've worked at Ford for the last 20 years and thought, I'm just gonna invest in the company that I work for, you basically watched the last 20 years of your deposits pretty much get cut in half, which, yeah, that sucks. Might as well just go buy a Ford truck. Those are the top 5 mistakes. So just to recap, mistake number 1, buying at resistance. Mistake number 2, selling at support. Mistake number 3, you're just not reading charts at all. Mistake number 4, you're just buying off hype. And mistake number 5, you're just gonna do business with the company that you work for, which sometimes can be a huge mistake because what if they fire you and the company's doing bad? You just got double screwed. I'm Jason Brown. I'm signing off saying you never go broke taking a profit. Hit the thumbs up, hit the like button, subscribe, and be sure to turn on the bell notifications so you can get notified when we release another video. I think we're ready. Had to warm up the vocals. La, 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 la. What's my intro? And go.